How does the tax reform, the new laws, would affect us? Stay tuned. I'll explain. Thank you. Hello, my awesome friends. Hope you had an awesome Christmas and New Year. Happy New Year. Tax season is almost here. And as we kick off the tax season, the Center on Budget and Policy Priorities, Get It Back campaign and the Financial Clinic have teamed up to help you sort through what tax reform might mean for your tax refund and what you can do to make the most out of your tax time. This is part one of three-part series. The Get It Back campaign helps eligible workers claim tax credits and use free tax filing assistance to maximize tax time. The Financial Clinic builds working poor people's financial security throughout direct services partnerships that embed financial security practices into nonprofit nationwide and policy campaigns in support of working families. This year, tax brings several changes that could impact your federal tax refund and changes how you file your taxes. Changes are as follows. Number one, new tax rates. The amount of tax you pay is based on your income bracket, maybe slightly lower or higher depending on your annual income. Two other factors are influence the amount of the taxes you include, other tax credits you are eligible for, and the amount of taxes you paid in advance throughout the year. Number two, eliminated exemptions. In the past, you could claim personal exemptions for yourself and your tax dependents. These exemptions reduced your taxable income, lowering the amount of taxes you pay. Unfortunately, now you can no longer claim these exemptions. Number three of the changes, increased standard deductions. The standard deduction, like other tax deductions, reduces your taxable income, which lowers the amount of taxes you pay at the end. Number three of the changes are increased standard deductions. The standard deduction, like other tax deductions, reduces your taxable income, which lowers the amount of taxes you pay. The new standard deduction has nearly doubled. Here's how the new standard deductions compare to last year. In 2018, single deduction was $6,350. 2019 is $12,000, have doubled almost. Head of household in 2018, it was $9,350. In 2019 is $18,000. Married filing joint in 2018, it was $12,700. 2019, it is $24,000, almost double. Number four of the changes, it is child tax credit changes. The child tax credit helps offset the cost of raising children by giving you money back at tax time. There are three significant changes to the tax credit for the children, the CTC, child tax credit. Number one is amount. The CTC child tax credit now worth up to $2,000 for each qualifying child under the age of 17. Previously, the credit was worth up to $1,000 per child. Number 2, minimum income. If you earn more than $2,500 in 2018 or 2019, you may be eligible for the refundable part of this credit worth up to $1,400, also known as additional child tax credit. This means that even if you don't owe taxes, you will still receive the refundable portion of it. Number 3, taxpayer identification requirement. Children you claim for the CTC, Child Tax Credit, must have a valid Social Security number, SSN, that authorizes work. As the tax filer, you and your spouse, if present, you can have individuals' tax identification number, also called ITIN numbers, or SSN, Social Security. Number 5, new credit for other dependents, family tax credit. As part of the changes to the CTC, there is a new $500 non-refundable tax credit available to you so you can use to claim dependents. This includes children 17 years of age and older with ITIN numbers, ITN, and other relatives, for example, dependent parents. Yes, you can claim your dependent parents if they live with you and you cover 50% or more of their expenses. Since this credit is non-refundable, it only helps reduce the taxes you owe and doesn't provide a refund. Number 6, itemized deductions changes. If you file a Schedule A in the past, there are several changes to itemized deductions. 3 that you should know about it are, number 1, state and local taxes. The amount you can deduct for a state and local income taxes, real estate taxes, and personal property taxes is limited to a combined total of $10,000 or $5,000 if you're married and filing separately. Number 2 of the deductions are home mortgage interest. Interest on home equity loans is no longer deductible. This is one of several changes to this deduction. Number 2, medical expenses. Medical and dental expenses are deductible if they are more than 7.5% of your adjusted gross income, AGI, which is the same as last year. My friends, what you need to know is that these tax law changes are temporary. These changes are effective when you file your taxes this year and expired after 2025, unless otherwise noted in 2026. These tax laws changes are set to revert to previous levels. Professional tax help is available. There are other changes under the tax reform that may affect you, since there are several factors that can influence the amount of taxes you owe and the size of your refund. It is very important to get help, to get tax help from a qualified tax preparer, a professional. My name is Betty Almirante, and I am a registered IRS professional tax preparer. My website is www.bettyalmirante.com.